So not sure what you've heard about the stock making that mid-morning turnaround, but overall it looked like a pretty solid report in a tough environment. Talk to us about what you're seeing in some of the end markets that you operate in.
Well, as you said, triple beat. Top-line revenue was ahead of estimates. Second consecutive quarterly earnings record, and EPS ahead of target. So very good. And we guided up for the fourth quarter. Demand continues to be strong. I would say our only challenges this year have been two weather-related events, the freeze in the first quarter and Hurricane Ida in September, and that took out one of our assets in Louisiana. We've got everything running. St. Charles operations are back up and running, and we're looking forward to a good fourth quarter and getting our product availabilities back. And now we just have to work through some logistics constraints and some shipping issues. I don't think it's bad as what you see with the inbound containers. But when it comes to trucking, the truck driver shortage does have an impact on products we ship by truck.
I feel like you're at the epicenter of so many of these big challenges that we talk about every day. And one thing analysts are wondering, Jim, is the interplay between costs and pricing. Looked like you had some very good pricing power. Is that going to continue? And what happens on the cost side?
Yeah, well, I think pricing power is a combination of things, but the main thing is demand has been so strong against a very tight supply backdrop, and we went into the weather events like Hurricane Ida with very tight inventories in all the chains. I don't really have a value chain right now that's not experiencing tight conditions, and that's primarily demand related. If you look downstream all the way to the brand owners, they're also tight on supply. So we need to get some stock back into all those value chains, and that's going to take some time. I did say on the call that I expected energy costs to be up quarter over quarter. That was really the only negative in the guide. Having said that, we have good feedstock flexibility and good position to try to mitigate those costs, and I do think higher operating rates will help offset some of it. But we go into winter, and we haven't really had a cold snap yet, with some pretty high natural gas prices, and we're keeping an eye on that and getting ready to mitigate that.
Jim, I wanted to ask you about your recent op-ed arguing for market-based carbon emissions trading system to try and improve environmental outlook in the long term. I wonder why you think that's the right system and why you have confidence that it will work. It has been tried, particularly in Europe over the last decade or so. It's not like it's a resounding success.
Yeah, I think when you look at energy-intensive industries that are globally traded commodities, they have to worry about being competitive. And if you get yourself uncompetitive versus, say, the Middle East or China, essentially what you do is you drive investments away, but you also drive carbon leakage into those environments. When you create both a little bit of a carrot and a stick, where you have emissions allowances that reduce over time, but you have carbon prices that allow you to offset the higher costs, you have the ability to bring the financial markets in and really accelerate those investments. We announced the investment in Alberta for that reason. They have a carbon price today of $45 a ton, and they have an allowance scheme that reduces over time. And so we'll make an investment there. They have existing infrastructure for carbon capture. We think if we could get a system like that in place in the United States for hard-to-abate, energy-intensive sectors, that would drive us forward faster than a tax, which would be a revenue collection for the government, but not necessarily going back to solve the climate problem.